I learned early on that no deal is better than a bad deal.
Hey everybody, this is Lorillia, and this week on the Never Lose a Deal podcast, I had the opportunity to bring on a guest. And so my guest is going to be Gino Barbaro. You're going to learn more about him during the episode, but Gino's going to give you a look inside of what it actually looks like to have the opportunity to scale a real estate portfolio. Now, I'm not going to spoil the details for you, but what I am going to say is that if you want to know what it looks like to put together creative financing, scale a real estate portfolio, then you need to really lean into today's podcast episode. Welcome, everybody, to another episode of the Never Lose a Deal podcast. Today, I have a special treat for you. I have a guest. I don't normally bring guests onto the show, but when I do, I just always want to make sure that it is in alignment with what we talk about here on the Never Lose a Deal podcast. We talk a lot about creative financing and scaling portfolios, and my guest today is an expert in that area. So, welcome to the show, Gino. I have Gino Barbaro. How are you doing today?
Lorella, you're putting the pressure on me early on. I am a special guest. You rarely bring on guests, so I feel the pressure. So I got to deliver today. How you doing?
Okay, I'm ready. So I was telling Gino before the show, I don't normally read out the bio that the guest gives me, but I'm going to give you a small piece of why you want to listen to Gino today.
Mhm.
Now, Gino, not only is he a certified money coach, but he is also a real estate investor who has scaled a portfolio of over 1,900 multifamily units. And
Mhm.
so I'm just going to go right on into it so we can learn more about Gino and what he does with real estate scaling. So, Gino, how would you describe yourself to the audience?
I would describe myself very simply as a guy who's winging it, trying to figure it out every day. When you use that word expert, I tend to cringe a little bit because, as you know, the experts have gotten it wrong over the last 15, 20, 30 plus years. I'm a father of six. I think that's probably the most important thing that is in my life. I've been married 27 years. I had a restaurant in New York for
Oh,
over 20 years, just one, Lorilla. I couldn't scale that. But when I got
okay.
into multifamily, I figured out a few things, and I think we should share them on the show today of how I went from one deal to owning over 1,900 multifamily units in the span of about 5 or 6 years. I was able to do that using various techniques: creative financing, syndication, JVs, partnerships. So for me, getting into real estate and getting into multifamily was just life changing for me.
That is so interesting because knowing that you started off with a restaurant and then went into real estate. So, what did that look like? Did you have the restaurant and you own the real estate? So what did that look like? Or you exit out of the restaurant business and said, "Hey, I'm going leaning in totally into real estate." Tell us about that journey.
I need to share the story of why multifamily for me, and I think it'll resonate for a lot of people listening to this.
Oh,
I was working in the restaurant for years, and finally, it was a Friday night in the middle of the winter, 8 o'clock. The parking lot's deserted. I'm the only one there with the shovel, shoveling about 6 inches of snow in the driveway. You can hear the shovel scrape the concrete. You can see myself. I've got no gloves on. I'm throwing down the calcium. I'm freezing, but I'm thinking to myself, here goes another week. I'm not getting paid. And I
mm,
was just so frustrated. My mom owned the building of the restaurant. So the restaurant was downstairs. Upstairs, she had 3 apartments that she was renting. And as I'm
okay.
out there freezing my ass off, I look up and there's a light on in one of the windows. And it dawned on me. I said, my mom is at home in bed getting paid in her sleep while I'm out here freezing my butt off and not getting paid. And that's when it clicked to me. I said, wow, I don't have to go and buy hundreds of units. My mom is getting paid from 3 rentals every month without fail. She doesn't care what the weather is. She's getting paid in her sleep. And that's when I said to myself, multifamily, this real estate thing, that's how I got locked in. And for me, it was just slow. I started out buying one deal, made a bunch of mistakes. Then I met my business partner, Jake. And I always say, Lorillia, there's life before Jake with me and life after Jake. And life before Jake was really sort of what the podcast says, never lose a deal. I didn't know what a deal was. That's the problem. I was making mistakes on the deals themselves. When I met Jake, we created this framework. We called it the buy right, the operate, and the exit. And that framework for us changed everything because then all of a sudden it became crystal clear of what a deal was to us, what it meant to us, how you buy this deal, how you operate this deal, and how you ultimately exit this deal, either through it's a refinance or a sale. So for me, staying in the restaurant was important because I had 5 kids at the time. I really need to preface that, and I want to really answer your question fully. I was in the restaurant. I met Jake. I started buying deals with Jake, and I didn't quit like most gurus will tell you. I needed to feed my family, and I needed to grow the real estate portfolio. So within the next 5 years, starting with Jake, I was able to work at the restaurant. I was able to start buying deals. All the money that I made in the real estate went back into the real estate portfolio. I didn't go buy the Lambos. I didn't go on the vacations. And the restaurant was there paying my bills. And at a certain point on March of 2016, I said, I have enough. I'm going to quit. I've got enough cash flow coming in from the real estate that can support my lifestyle. And I was able to ultimately walk away from the restaurant business.
That's a lot. But I'm glad that you made a distinction on you and your partner being
Mm-hmm.
able to create a framework of how to put deals together, and
Mm-hmm.
then you also being very transparent with knowing you didn't know what a deal looked like. And
Mm-hmm.
that's so in alignment of what I talk about on this show, because the internet has confused mostly new investors that just buying something is a deal. And
Mm-hmm.
that's totally far from the truth. So
Mm-hmm.
can you tell us a little bit about that season where you were, like you said, you didn't know what a deal was until you met Jake? What was that like?
It was painful. And I learned early on that no deal is better than a bad deal. Let me repeat that because everyone's around, especially in 2020 and 2021 and 2022. We're running out and trying to secure deals with bridge financing. Well,
Mhm.
how are those deals working now? It's no deal is better than a bad deal. And let me clarify that even more. What does a deal even look like? A deal to Gino right now, with the experience and the capital that I have today, is very different than a deal that Gino and Jake started on our very first deal. On our very first deal back in 2013, we bought a 25 unit little crack den motel that had weekly renters. It had bed bugs. It had failing septic systems. It was a deal for us because it met our parameters. We were able to add value to that deal and we bought it at a great price. But today, that is not a deal for Jake and myself. And the biggest mistake that beginning investors make is they don't treat multifamily or any kind of real estate, even single family homes, as a business. We're looking at it as an investment, as being a landlord. But if you don't implement systems and put systems into that real estate business, you're ultimately going to fail. And that's the problem. I want you, anyone listening to this, when you're buying an asset, you are buying a future stream of revenue. You need to understand that that stream of revenue has income and it has expenses and it needs to be managed. And most investors don't look at it from that perspective. They just look at it as buying a deal and hopefully it may work out. We can talk about what a deal looks like to everybody and how to actually structure a deal and what that deal can ultimately bring to you because the exit's important. But Laura, the biggest mistake that I see is most investors going in there not understanding that it's a business and not having a certain criteria on how to buy these assets.
Exactly. And take us to, like you said, even though that deal, if you were looking at it, you and Jake were looking at it now, it wouldn't be a deal. A lot what we talk about on the show is financing.
Hmm.
What type of financing did you all secure, or did you all have a private lender? Talk a little bit about that with that deal that you just gave an example to.
Well, you're going to love the financing because we got an 80% bank loan, 10% seller finance note, which we bought it in 2013, and we literally paid off that finance note last month. That's how long we had that finance note because the sellers were mom and pops. They were motivated, and that's what you need to make money in real estate, you need a motivated seller. If you don't
Hmm.
have a motivated seller, you're not going to get a deal. But it was 80% bank financed, 10% seller note, and we had to bring 10%. It was a 25 unit deal. We paid $600,000 for the deal. So we needed to come up with a total of $83,000 for the down payment because of the other 10% was the note. So it was me, Jake, and my brother Mark. We partnered up on this first deal. And the reason we got the financing was we had a great broker, Ricky G. And that's what multifamily and real estate's all about. You need great brokers. If you don't have a great broker, they're not going to be an advocate for you. He actually walked us through the deal. He said, this is a great deal because you're going to have financing on this. You're going to be able to turn these weekly renters into monthly renters. These expenses are crazy. They're paying for cable. Why are they doing that? Look at this garbage bill. So we were able to go in there, stabilize the income, put some systems in, create a website, and then drop those expenses. And that's why for us, that first deal was a home run because we bought it at a good price, but we were able to implement so many different value adds to that property. And to this day, we still own that property.
Okay. And was the value add over time? Because you mentioned about, the income stream of the rent. So I'm not going to assume, but when you did your evaluations, did the numbers work that the rental stream that you all were getting in the state that it was in, it made sense for you and your partner's buy box?
Great question. I love that question because it denotes back in the day, you could actually buy properties based on actual numbers and have an actual cash on cash return. Cap rates back then were really high on these older properties. As the market cycle lengthened to where we are now, these older properties, these cap rates have really compressed and they're really competing with the newer properties. That's why right now, that's not a deal for us at the price points that they're trying to sell them at. But back then, we bought it on an actual cash on cash return of over 10%. We were able to explode that because back then, remember, when you take a look at history, we always forget of how bad it really was in 2011 and 2012. It was horrible. I mean, GDP was 1%. Banks were not lending. That's why we had owner financing. There
Mhm.
was a ton of deals out there. And more importantly, there was not a lot of capital flowing to the asset. Capital was flowing elsewhere. It was going to commodities. It was going to stocks. It wasn't coming into real estate because everyone was afraid. So for us, we were able to buy this thing at a great price point. We were able to implement these strategies within the next 18 months. I remember December of 2015, a little over 2 years, we were able to refinance out $165,000. So we put
Mm.
down 83, we refinanced out $165,000. We stabilized the deal. We took that money, and that money went into our next investment.
Okay, okay. And so where are you and your partner at now in terms of, are you all still buying? Because one of the things that many investors always say, okay, in this environment, in 2026, a lot of unrest in the US or, outside in, the US, and with interest rates and all other, doom and gloom in real estate, are you and your partner buying now?
In 2023, we bought $25 million of real estate. 2024, $25 million of real estate. Last year, we bought over $15 million of real estate. If there's a deal out there to buy, we're going to buy it. And I really don't understand how people call it. There's always doom and gloom scenarios. You can always create the scenario in your mind. Interest rates being higher, it's actually harder to make deals work. That's why you have to be more diligent. You have to understand what your exit strategy is. If you're buying a deal and trying to time the market, it may be a little bit more challenging. But if you're buying a deal and you're able to have a little bit more time, it's important. And I think one other concept that we have right now in this part of the market cycle, it's a little bit harder to raise money. Raising capital right now is hard because LPs, investors, they're a little skittish. They've
Mhm,
been burned. They're a
mhm,
little bit afraid.
mhm.
But seller financing is working pretty good in this part of the market cycle. You just need to stick with it and make sure that you do have a business plan. You know how to execute that business plan, and you know what kind of deal it is that you're looking for. So when that deal pops up on the radar, you need to move quick because there are people out there with capital. It's just the opportunities are slowly coming back. Once they do come back, like they did back in 2011 and 12, they're going to flood the market, and there's going to be a lot of opportunities, but there's not going to be a lot of cash or a lot of capital to capitalize on those opportunities.
Okay. And now with your framework that you mentioned, you said you and your partner, you all have a framework. Now,
Mhm.
is this framework for real estate operators who are at a certain level in their real estate business? Like, is it only for, investors who only have single families or only do short-term rentals or only do multis, but they got to be, 4-unit multis? What does that look like with your framework and the investors that you work for? Do they have to be doing big multis, 10-unit apartment buildings or 15 or 20?
I would say the framework is for anybody who's buying a business or investing in real estate, and I'll show you why. There may be little caveats because seller, self storage may have different operating expenses than does a multifamily. But real quick, I'm going to walk you through the framework and
Okay.
the buy right. When you're buying an asset, you have to have some type of criteria when you're buying a business. What kind of business are you buying? What are the KPIs? Specifically in multifamily, when we're looking to buy an asset, we want to look at the median income of an area. If it's above $50,000 for us in Tennessee, we're okay with that. We're looking for a certain resident base. We're
Mhm.
looking for a certain number of units. Are we looking between 20 units and 200 units? That's what we're looking for. We're
Oh,
looking for a certain unit mix. We love 2-bed, 1.5-bath townhomes. If they've got garages, even better, because that feels more like an apartment home and it's more desirable. So right
mhm.
now, you've got median income, you've got location, you've got unit mix, number of units. Let's talk about amenities. We love washer and dryer hookups if they have them in the units because that's what residents really like right now. So we got some amenities going in there right now. So understanding what your criteria looks like, the age of the asset. Right now, we like assets that are a little bit newer. If we're going to go and buy an older asset that has cast iron plumbing, that has aluminum wiring, we're okay with that, but we're not paying what the sellers want. We're going to get that
Yes.
at a material discount. So you see how things become crystal clear? All of a
Mhm.
sudden, I can talk to Lorillia and say, I'm looking for a deal in Knoxville, median income 50,000, 2-bed, 1.5-bath townhomes, median income over 50 grand. We love between 20 and 200 units if that's what you got. If you got washer and dryers, oh great, brick exterior, anything 80s or newer. Now I'm clear, and now you're clear as the broker. When that deal comes, they're coming to me right now. You sound professional. That's important. That's the buy right. Whenever you're buying or investing in an asset or a business, you need to be clear on what it is that you're investing in. The next part is the operate right. You could spend hours on talking about the operations of an asset, but if you've been in multifamily the last 3 or 4 years, most people didn't buy these assets to operate. They bought them to flip them, and now they're stuck with the hot potato because they didn't know the operational, efficiencies of how to operate this asset. So we really focus on the manage right portion of this business, how to manage this with having KPIs, with having cadences of accountabilities and rhythms within the business. The third part is the exit, or what you're talking about as well, is the finance portion of the business. You can finance this deal with credit unions, which we're using. Great credit unions are awesome right now. They've done such an amazing job to fill the void because
Mhm.
community banks haven't been as competitive with their rates. Fannie and Freddie, it's a lot harder right now because their LTVs are a lot lower. They want to take a lot less risk, and
Mhm.
interest rates are hampering them. So, understanding all three of those components, I'm not coming to you with the strategy. I know how to invest and run this asset, and I've got an exit with this asset, and I've got certain financing. Putting all three of those together, you're going to be a much more successful investor than you are if you're Gino out there hunting for a multifamily going, I want a deal. What's a deal? Where's a deal? I don't know how I'm going to finance this thing. Manage it? I got to manage this? Really? I don't even know what manage looks like. But you see, when you start focusing on and creating those pillars for this asset, you get a much better idea. You have a map. There's a roadmap for you to follow. And every time you're looking at a deal, it's easier for you to underwrite that deal, operate the deal, and then ultimately exit that deal.
Exactly. And I like how you and your partner created, what's called buy right. And that's why I always tell investors, you got to know your buy box.
Mm,
You got to know what it is
sure.
that works for you,
Yes.
not you let the lender or the seller or even the broker tell you what you need to buy, which is
Yeah.
why some people, it ends up being a bad situation because you never knew what was your buy box.
Hmm.
You never knew that.
I
So
agree.
that's a good example. So is that part of that's your three-step framework, right?
Mm,
Is that
yep.
okay? All right. And so you work with investors, or how does that work? Do is it new investors come to you, seasoned investors? Because I know you did mention about it can work for a business too. And I feel like a business has different KPIs. I know you mentioned self-storage, but let's just say it's a real estate, a restaurant, but the restaurant doesn't own the real estate.
Oh,
How does
yes.
that work?
Yes. Well, for me, I just use that framework for multifamily. We used to have an education company called Jake and Gino. We sold the education arm off because I got into money coaching. I realized that most people fail in business not because of the skills that they have, it's because of the mindset that they have. It's because
Mm,
of the patterns, the behaviors, and the beliefs they have around money that they adopted unconsciously when they were younger. Now they're adults working on the same framework that they adopted when they're 8 or 9 years old. I can teach you all about these deals, and I've taught tons of students. Some of them did really well, and some of them didn't. And I was always so curious as to why the ones that didn't close deals, why weren't they closing deals? And it always came back to a person's relationship with money and their mindset. But to your question specifically, well, every different asset class, they should follow this framework. We've built this specifically for multifamily, and we have all the different teachings within multifamily. But if you're buying a business, you still need financing. You still need to know what financing looks like. Are you getting an SBA loan? Are you going to a bank? Are you getting private money? Are you actually getting a note from the seller? You need all that when you're buying a business as well. You still need the KPIs in the business. You need to formulate KPIs that run in that business specifically. I've got ones for multifamily that we use, and even the buy box. What does a business look like when you're buying the business? What are you looking for? You're looking for foot traffic. Are you looking for location? Are you looking for a brand? That's all specific to that asset class. But what I'm saying is, if any asset you're buying needs to go through those three pillars, you need to develop and design what that looks like for the specific asset class.
exactly. And and I'm glad that you mentioned about mindset, and I'm glad that you said you do talk a lot about that. I definitely get that. Take us to the Gino, like you said, before Jake, because this is what I don't think a lot of people realize. Was there an identity shift that you had to go through from being when you were just Gino with the restaurant and your mom owned the real estate to the Gino when you got with your partner, Jake? What was that identity shift like?
The identity shift was important, but what I want to do with the listeners right now, I want to share a concept that
Oh,
revolutionized and made me understand what was holding me back in business.
mhm,
In money coaching, there's a term called a financial flashpoint. That's basically an emotion around money that you have, and it gets encoded into your DNA. It can
mm,
be a positive one, it can be a negative one. Now,
mm,
people also call it a money trauma, but I don't like to use the word trauma, but it's very similar. When I was 5 years old, I went to the store with my grandmother, and she was Italian. She couldn't speak English. And I remember her walking me into the A&P in New York. And we walked in, and I saw this bag of toy soldiers, and I wanted to buy those toy soldiers. I said, Grandma, Grandma, can I buy them? And she said in Italian, she said, Tesoro, she said, sweetheart, I don't have the money. When your mom comes to pick you up, we'll come back and buy them. And I remember leaving that store, crying, dejected, going home without my toy soldiers. I get home, I don't remember if we ever went back. But what I realized that Flashpoint did to me was it encoded fear, scarcity, not having enough, being poor. And all of a sudden, I started developing that framework around money. As I got older, my parents were both immigrants. All I heard was save for a rainy day, never for a sunny day, for a rainy day. So I had a lot of money vigilance, one of the money scripts that we have in money coaching, where I was just really being, fearful, having that scarcity mindset, and I realized that it developed a lot of behaviors around money. I had a lot of limiting beliefs around money early on. It takes money to make money. Money doesn't grow on trees. What really ended up happening, Lorilla, was I started taking action, and I started seeing that those scripts were incorrect. Our first deal, seller financing. I mean, that's not money. That's a skill. All of a sudden, I started to understand that, wow, if I want to get good at something, I need to learn something. Money is not holding me back. The lack of skill and the lack of knowledge is what was really holding me back early on. And then on our fifth deal, we did an $11 million fully seller finance deal. The seller held 20% of the note. The bank gave 80%. So from that point on, game over. And then ultimately, my identity did shift. To really answer your question, I was the pizza guy. Once I understood, wow, I am the pizza guy, but I'm also the multifamily guy. And I think that's what we need to do internally, because the multifamily guy doesn't make excuses. He calls brokers. He has a framework. He reaches out to investors. He underwrites deals. He puts in LOIs. He goes to conferences. He calls brokers. He does property tours. The pizza guy doesn't do that, but the multifamily guy does that. And I think we all have to identify and understand what that identity looks like, and we start accessing it. And there's a quick story that illustrates what happened with that mindset. I was at the restaurant in my shed. I was putting away pizza boxes. I was doing basically $10 an hour work. I was in the shed, and I've got the phone jammed to my neck, and I'm talking to Jake, and we're underwriting this $11 million deal that I was talking about. And I stopped and I sat there for a second, and I said, what the hell am I doing here? I'm negotiating an $11 million deal, and I'm doing $11 an hour work here. There's something wrong here. And that's when I realized I'm not the pizza guy anymore. I'm the multifamily guy, and I need to get rid of this business that I have here to focus on the real estate. And that was the shift. Within 6 months, I was able to leave the restaurant and go into real estate. So when your point is so spot on, that mindset is everything and identity is everything. And that's why it took me so long to realize that restaurant is great, but where I really need to be, where I really need to focus on, is in the real estate space.
Okay. Well, I know we're going to have those listeners and those who are watching to say, oh, well, that's great. Gino, he had a Jake. Where can I find a Jake? Tell us a little bit about that. Like, how did the relationship with you and Jake even form? Because it seems like, and I know we don't have enough time, that when you did partner with Jake, you took on bigger deals. So how did that relationship start, and how you were introduced to him?
Well, Jake was great, but I had pretty bad Jakes before I met Jake. I had some really bad partnerships before Jake. But one thing that really worked out well for me, one of my mentors taught me this concept, or this phrase, values-based decision making. And it's a simple concept, but every decision that you make in your life, from what you eat, from where you go on vacation, from the partners that you have, for the types of investments that you make, it all has to align with your values. When I met Jake, our values completely aligned. He was young. He was a grinder. He was a hustler. He had growth mindset. He was hungry. He wanted multifamily. He wasn't a get rich quick kind of person. I mean, it's like we're two peas in a pod. We really fell in line. And what really worked for us is we were both radically accountable to each other. So I always say to myself, people are always complaining about their partner, but have they ever looked in the mirror and said, well, I'm a great partner. I never let my partner down. I never make excuses. I'm always there. I mean, for example, tomorrow I've got a podcast with Jake. We're doing a podcast. Instead of him being on the podcast, he's going to tour some properties in 45 minutes out. He's not making excuses. He's like, oh, I can't. He's going to go out and look at those properties because that's for the viability of the business. And we're going to divide and conquer. I'm going to do the podcast. So when you're looking for a partner, you need to look for a partner that's going to align with your values. First of all, you need to know what your values are. Most people don't. That's the problem. The second problem is you need to know what kind of asset class you're investing in, and are you going to be doing it long term? Because one partner may want to invest in single families, the other one may want to do self-storage. That partnership's not going to really work out. You need to be on the same page. And then for us, having responsibility, having control, having a long-term mindset, all of that really worked really, really hard. And then ultimately, the last reason is we just sort of liked each other. We can go at the end of the day, have a beer, and sit down and get along. So having the values-based decision-making, having the same goals, and really sort of liking your partner is important. But what's really interesting is if you have that all crystallized and you start looking when you need something, it tends to appear. But you need to know what that looks like in your mind. You need to look like, what does that Jake look like to you? And I knew that I needed somebody who wanted to work hard, who's really radically accountable and who could, execute relentlessly. And that's the kind of partner that I had. But I need to show up that way as a partner as well.
That's great. That's great. Well, this has been a great conversation, Gino, and I definitely took some great takeaways from this conversation. But please let the listening audience know if they wanted to learn more about you, how they can learn more about your podcast and you and Jake and whatever you have to offer.
Just go to jakeandgino.com. We have a bunch of podcasts on there. That's where we host our podcast. I do a weekly show on how to real estate. If you want to learn more about working with the family, we've got a family company called Barbaro 360. It's BARBARO 360.com. You can find out more about us on that website.
Okay. Well, as always, this was a great conversation. And I am looking forward to possibly have another conversation with you in the future. So once again, this is the Never Lose a Deal podcast. Until the next. Wasn't that a great episode? One of the biggest takeaways that I got from that podcast episode, I don't know about you, but is understanding your buy box. Now, Gino called it the opportunity to buy right. But here on the podcast, I talk a lot about your buy box. And so that is what was discussed in the podcast episode. So if you are someone who wants to scale their real estate portfolio, or you are looking to expand your real estate portfolio, you need to know what that looks like. But if you would like to have a conversation with me so we can do a deep dive further into what your buy box can look like to scale your portfolio, please go to the link right here on the website, loseadeal.com, and let's have a conversation so you can get clarity and so you can begin to scale out your real estate portfolio. Until the next time, I'll see you in the next episode.